Hello, welcome to your daily solo 401k webinar Q&A session with my solo 401k financial, where we try to help you stop overpaying taxes and start building real retirement wealth, utilizing tax shelter vehicles like IRAs and 401ks, for example. So today's topic is, how do I avoid 20% tax on my 401k withdrawal? This is a question that comes up not only in the context of a traditional full-time employer 401k, but also for self-directed solo 401k plans for the self-employed, also known as owner-only solo 401k plans. So this is definitely a good topic. As always, please go ahead and type over your questions during today's webinar. Type them over so we can make sure to get to them all, and we'll pause and answer those questions as they come in. So let's get started here. So withdrawing money from a 401k can be expensive, particularly more expensive than most 401k participants expect. Not because of the tax rate itself, but because mandatory federal tax withholding applies. Many account holders are surprised to learn that a large portion of their money is sent straight to the IRS before they ever receive the funds. So we're unpacking this today. But the good news is that in many cases, this 20% mandatory federal tax withholding can be avoided entirely with proper planning. So let's break this down. Get to my slides here. Okay, so why 401k withdrawals surprise people? So this is very, very common where an individual is exploring making a distribution. They may have done some planning as to what to do with those funds, and then they find out at the last minute that they're only going to receive 80% of the funds because Uncle Sam expects the other 20% in mandatory federal taxes to be paid up front. So the same distribution rules apply to all 401k plans. That's actually a very important item to understand. So whether it's a traditional full-time employer 401k or a self-employed solo 401k plan, it still follows the exact same distribution rules. So whether you're taking money from your traditional employer 401k or from your self-employed solo 401k, the rules are essentially the same. So before you can withdraw funds, you must meet a triggering event. What are some of those triggering events? And these are all IRS statutory regulations. So you have to reach age 59 and a half before you can distribute the employee contributions. Think about it as salary deferral or employee contributions. You have to reach age 59 and a half before you can distribute those funds. If you have profit sharing employer contributions in that full-time employer 401k or solo 401k, those funds can typically be distributed if you've had that 401k or solo 401k for at least 5 years, or if you have contributions in that plan that have been in there for a couple years. So you need to understand how the distribution rules apply to each source. Another triggering event is separation from service, which means that once you stop being self-employed, for example, that's a triggering event. You can actually take a taxable distribution from the solo 401k. Same thing with the full-time employer 401k. Once you leave that day job employer, you can take a distribution from that 401k. Other triggering events, which are not as nice, are disability, death. I mean, who wants to be able to take a distribution because of those two scenarios? And of course, the final one is plan termination. So when you decide to, and this is really more for a solo 401k plan because it's sponsored by an owner-only business. So if you decide to close your solo 401k or your business, then that would be a triggering event. Obviously, if we're talking about a full-time employer 401k, let's say you work for a small company that offers a 401k, if that company goes under or they decide to close their doors, then that would be a reason for plan termination. Therefore, the employees, aka participants, and that full-time employer 401k would be able to transfer their funds out or even take a taxable distribution. So in short, without a valid triggering event, distributions from 401k plans, whether a full-time employer 401k or a solo 401k, are not allowed. Looks like we've got a question here. Let's take a look at that. Do I need to set up an IRA to avoid the 20%? That's exactly right. And we're going to get to that slide in a moment. But you hit the nail on the head. And we'll talk about that more here shortly. So good question. So again, go ahead and type over your questions. They don't have to be specific to today's topic. They can be surrounding any aspect regarding 401k plans, whether a full-time employer 401k, solo 401k, or even IRAs. So what is the mandatory withholding that applies to 401k plans? If you take a taxable distribution directly from a 401k, federal law requires the plan trustee to withhold federal taxes from that distribution. It's 20% for federal taxes, so federal income taxes. So this withholding applies regardless of your actual tax bracket. So whether you're in a high tax bracket or a low tax bracket, the mandatory 20% federal tax applies across all 401k plans. So the key items to understand is that the 20% federal tax is not a penalty. So don't confuse the 20% federal tax with the 10% distribution penalty. The 10% distribution penalty is separate, and that's on top of the 20%. And that 10% distribution penalty only applies if you are under age 59 and a half when you make that distribution. So let's say you close your business or you separate from your daytime employer 401k and you're under age 59 and a half. Well, that's a triggering event with regards to being able to take a distribution. However, because you're under age 59 and a half, you're going to have to pay a 10% penalty as well on top of federal taxes. So think about it as a penalty to access your money, because remember, the whole purpose of retirement plans, whether 401ks or IRAs, at least in the eyes of the government, is to save for retirement. So it'll be there to hopefully be able to use in conjunction with Social Security if we have any Social Security available at that time. So think about that 10% penalty as having to pay a penalty for distributing your funds from your plan before retirement age. So again, this 20% is a federal tax. It's a prepayment of federal income taxes. So the withheld account, or excuse me, this withheld amount of 20% of federal taxes must be sent electronically to the U.S. Treasury by the 15th of the month of the following month, of when the distribution took place. So, for example, let's say you take a distribution in February. You're going to have to pay 20% of federal taxes on that distribution amount by March 15. So the next month. So when those taxes are due. Now, if we're talking about a full-time employer 401k, the administrator is going to actually send that 20% federal tax directly to the U.S. Treasury, and then you're only going to get 80% of that distribution. So let's say you distribute $10,000 from that full-time employer 401k, you're going to receive $8,000, and that employer is going to say, the administrator of that employer 401k will send the 20%, so the 2,000, to the Department of the Treasury. Now, in the context of a solo 401k plan, it's more complicated because you are the trustee of the solo 401k plan. So if you take a distribution from your solo 401k, again, you have to pay 20% of federal taxes up front. So using that same $10,000 example, you're going to have to send $2,000 of that $10,000 directly from the solo 401k to the Department of the Treasury. And you're going to have to actually sign up with the EFAST system so that you can pay that federal tax electronically. And then you're going to get some type of PIN number. Then once you get that PIN number, you have to then link your solo 401k bank or brokerage account directly with the Treasury Department account number, and the funds get paid electronically. So when you pay this tax, you receive a credit for this amount when you file your personal tax return. So depending on your tax bracket, this could result in a tax refund, or you still may even owe more taxes. Because anytime you distribute funds from any type of 401k, especially pre-tax 401k funds, that's going to be considered a distribution subject to federal taxes, which may bump you into a higher tax bracket. So you always want to plan before you distribute funds from any type of 401k, as it may bump you into a higher tax bracket. So it may be best, if you have to take a distribution, to make it in years that you're going to be in a low income tax bracket. That's what you want to discuss with your CPA, financial planner, before you make any type of distribution, whether from a full-time employer 401k, owner-only solo 401k, or even an IRA. So why? So we just talked about how the withholding works. Now, why the 20% withholding is a cash flow issue? So this is especially important if you're planning to make a distribution from your 401k and you need to use those funds for a certain reason. So even though the withholding is going to be credited later, it can still be problematic because you immediately lose access to 20% of your funds. So using that 10,000 example, you're not going to receive the full 10,000 now. You're only going to get $8,000. Also, you may not owe that much in taxes in the end. So when you go to file your personal tax return, maybe you're in a lower tax bracket and you didn't need to pay that upfront federal tax. So you're going to have to wait until tax filing season to recover any excess federal tax payments. So for many people, especially owner-only businesses, so self-employed individuals, this upfront loss of liquidity is far from ideal. They may need those funds for business purposes, or to buy a home, or to pay for other expenses. So how to avoid the 20% federal tax withholding? Let's talk about that. So here is the key strategy most people don't realize is available. Instead of taking a distribution directly from your traditional 401k or your solo 401k, you can actually directly roll over that amount that you want to distribute or withdraw from your 401k to an IRA, and then take the distribution from the IRA, not the 401k. Why does this work? Well, again, 401k distributions are subject to mandatory tax withholding. IRA distributions are not. That's one of the big differences between an individual retirement arrangement, aka IRA, versus a 401k, a defined contribution plan, and that is that you are now required to pay federal taxes up front from that distribution. So this means that no 20% federal tax withholding. You actually control when and how taxes are paid. So you can pay taxes later when filing your personal return or via estimated payments if needed. So obviously an important note is that you still owe federal income taxes on that IRA distribution, but you are no longer forced to prepay 20% immediately. And especially if we're referring to a solo 401k plan where you're the trustee of the plan, you're not going to have to register with eFast and making sure you make that payment. Then you have to file a Form 945 by January 31st of the following year to get credit for that payment. If you don't file that form, you'll get a letter from the IRS asking where's the format. So if anytime you have a solo 401k plan and you're making a distribution from that solo 401k, it's always going to be best all around to transfer those funds that you want to distribute to an IRA and then make the distribution from the IRA so that you don't have to finagle with having to pay that 20% federal tax up front, making sure you sign up with the Department of the Treasury to make that payment electronically. You have to do it by the 15th of the month of the following month. So that's why it's always best if you are a self-employed individual and have a solo 401k plan to transfer those funds that you want to distribute to an IRA and then make the distribution from that IRA. Looks like we've got some questions here, and then let's take a look at that. Can we get the slides emailed to us after this presentation? Yes, well, actually, you're going to be able to view these slides on our YouTube channel. So you can actually subscribe to our YouTube channel. So if this information is helping you feel more confident about your 401k and IRA and your future, then it'd be nice if you take 1 second to like and subscribe to our YouTube channel and our various social platforms. It tells the platform that this content is valuable, which it'll help others out there to find it. So subscribing also guarantees that you get notifications of all our crucial content that we deliver every day to help you secure your retirement. Okay, let's take a look at this next slide here, why a direct rollover works. So, and I think we covered this already of why direct rollover works, because you're directly rolling over those funds that you want to distribute from the 401k directly to the IRA. So they never go to your personal bank account. They get directly rolled over to an IRA. And then once inside that IRA, then you make the distribution from the IRA. And again, with IRAs, you're not required to have any taxes withheld up front like you do with the 401k. So let's see here. What about the 10% early distribution penalty? So we talked about that. So again, avoiding the 20% withholding of federal taxes does not eliminate the potential for a 10% early distribution penalty if you are under age 59 and a half. So whether you take a distribution from a 401k or an IRA and you're under age 59 and a half, you typically have to pay a 10% penalty. There are some exceptions, and we'll cover that in future webinars. But the rule of thumb is that generally, you do not want to take a distribution from an IRA or a 401k unless you're age 59 and a half or older, so that you don't have to pay that 10% penalty, which again is not a federal tax, it's a penalty. So that's on top of any federal taxes and possible state taxes, depending on your state of residence, that apply when you make a distribution from any 401k or an IRA. So some final takeaways here are that the 20% mandatory tax withholding on a 401k distribution often catches people off guard, but it is not unavoidable. By using a direct rollover from a 401k or a solo 401k to an IRA, where you directly roll those funds to the IRA. So those funds never get deposited to your personal bank account, but they get directly rolled over to that IRA. So the check is made payable in the name of the IRA custodian, and the funds are deposited directly to that IRA. Then that's a way to avoid mandatory upfront federal tax withholding of 20%, which will help you preserve your cash flow because you can pay taxes on your own timeline. So you're always going to have to pay taxes, most likely, depending on your tax bracket, but you can try to control as far as how quickly Uncle Sam gets a hold of those funds. So whether you have a traditional employer 401k or a self-employed solo 401k, understanding this distinction can make a significant financial difference. All right. I don't see any other questions at the moment. So we appreciate you joining today's daily webinar. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so that we can keep building this community. We'll be back again here tomorrow with more great content. Until then, have a good rest of the day.